What up, everyone? I'm Alex, CEO and founder of MarsBased, and this is a new episode of Life on Mars. And in this one, we'll be talking to Mike Counihan, Managing Director of Transcend Partners, one international M&A boutique that helps companies do their M&A and also raise capital, among other services. We'll be talking about what to do when you are approached by a potential buyer for your company. That is, from the first approach, what kind of message to send, what kind of meetings should you take, what is the protocol, should you go in person, should you do it remotely, when to approach an M&A boutique, and whatnot. We'll be talking about a lot of things, of all the sales cycle of a company, but unfortunately we didn't have time to cover all of it. So we had to split this conversation in two, and right now you're going to be enjoying the first part of this conversation with Mike Counihan. Hello, Mike. How are you doing? Welcome to the show.
I'm great, Alex. Thanks for having me. Pleasure to be here.
Mike Counihan, we're going to be talking tonight, whenever you listen to this podcast, about what to do when you're approached by a buyer. Because this is something that, founders and CEOs, they tend to idealize. I'm saying they because MarsBased is not, we will not be selling, but a lot of people say I'm going to create a company and just going to IPO, I'm going to sell it. Nothing farther from the truth, right? That happens only in a minority of cases, and you're going to be talking about that. What's a little bit of your background expertise on this, just to give some context to the audience?
Sure. So I've been working in M&A for about 10 years, 100% technology focused. So helping technology companies to either raise capital, sell their company. That falls under the M&A category when you're getting acquired by a bigger company typically. Or buy side M&A is when a company wants to acquire smaller companies or complementary companies to their business. There can also be mergers. Merger is a term that gets thrown around a lot, and it's, for the context of this discussion, I think we can just define it as, an acquisition one way or the other of similar sized companies. So we've done acquisitions that were technically mergers, but that's in a legal sense. So we don't need to get into that for this discussion. It's, when the companies are approximately the same size, it's a merger, or when one's bigger than the other, there's an acquisition typically. And so I've been doing that for the last 10 years, all technology sector, quite a bit in software, internet space. Those are kind of the two big spaces that we've worked in. I would say a bit more in software than internet. And that's pretty much it. My background prior to M&A was working in investing. I started at Citigroup in San Francisco. So I was on a team. We did equity research on technology companies, and we would write trade recommendations to institutional clients, such as pension funds, mutual funds, and then we would also make investments ourselves. So if we wrote a recommendation for, buy this company, we think it's a good buy at this price level currently, then we would also buy that company ourselves, kind of, not telling somebody else to do something that we wouldn't do ourselves. We invested $2 million in each of those. And over my period on this desk of 3 people, me and 2 other people, we invested in over 50 companies, so over 100 million. So that was kind of my introduction into the investing world and technology, kind of analysis of technology companies. After that, I worked at a hedge fund in New York City, and I worked at Merrill Lynch in London doing similar activities as well.
Let's talk about the expectations, right? Because I think that's the hardest truth to swallow. So a lot of people think they're going to IPO, they're going to sell by billions, they're going to become unicorns, right? Yeah. The reason why we're recording this podcast is, we've known each other for quite some years already, but you shared with me the other day one really interesting TechCrunch article from 2018 about selling the company, right? And the delusional effect of thinking that you're going to sell your company and reality hitting you hard in the face, right? And one of the interesting things that it mentions is that, most of the exits happens before Series B, which is far from what we see in television, or because we're affected by survivorship bias, right? Yeah. Like that, we're only seeing oh my God, Instagram sold to Facebook. WhatsApp sold to Facebook for this fortune. But we don't get to see the failed sales, like the non-interesting sales, the undisclosed amounts, and things like that. So All right, let's talk about that. What's the can you share some of the facts and figures that you've seen throughout all your accumulated experience in the sector?
Yeah, definitely. And I think, we can talk about specific facts in general, but also kind of generalities. In part of, the article, so I should have reread the article, but so I sent that article to you maybe, I don't know, a couple of weeks ago. Yeah. And I read it before I sent it to you. I haven't read it since, but I remember the point that you made, which is actually a favorable point for technology founders, which is a lot of them don't need to get a Series B or C. Some of them don't qualify for it. They tried to raise it and they were unable to. So they just kept, but their business was able to keep going. So they kept going, hopefully growing the business or keep, running the business, and then they sell their company. But in those cases, suppose they didn't need it. Suppose they got to profitability, which is a great goal for a startup to have. They get to profitability after their Series A. They have a much bigger pool of cash for themselves. They're much less diluted in those cases. So, a lot of it speaks to that reality as well. It's not necessary to get to Series C or D. Some business models are just money, cash burning business models. A lot of the, high customer acquisition business models in the web, like B2C, have to acquire millions of people, but a lot of businesses don't require that. So it's, you can raise a seed, put together a nice product, grow it yourself, get to profitability and sell your company. And a lot of these companies are not even heard of. So we've worked with several companies that didn't do a press release, didn't really announce the sale, very good sales, not enormous, but, more than 10 million euros, for example, in many cases. And they, they don't feel a need to do a big publicity. So it's, I think that's a, there's a lot of things. I guess the reason I'm mentioning that is there's so much that goes on that's unheard of. So there's not only survivorship bias, which you mentioned, but there's also just, I guess, kind of self publicizing bias, because only, a certain percentage of the companies mentioned publicly, apart from their family and friends, that they were able to sell their company. So it's, and there's just, so between those two biases, there's just a ton of missing information.
Yeah, and one of the things we'll be touching on is the fact that a lot of the company sales are either failed, so they don't come to fruition, or they are just like underperforming, and it'll be like, this is like you don't really make money, or you get just shares, so they don't go very well. In fact, our most performing podcast episode on the Spanish feed of Life on Mars is about one company sale that didn't really go well. With the episode with Laura Gascon, I really recommend you guys hear it, because it's really good. It's just like, so she sold her company, it didn't go well. Right? We didn't talk about numbers, couldn't be disclosed, but like it didn't go well. There were a lot of problems, and therefore no one ever heard about that sale, right? Before we get into the main topic, which is when you get approached by a buyer, a lot of companies start thinking about selling before they even create a company, right? And I'm speaking now from the point of view as an investor, right? I see a lot of decks where they talk about the exit. Like for me, that's a huge red flag. Might not be for other investors, and I want to hear your opinion on this, right? But most of them are like, unless they come from, the founders come from a big corporation, they have 10 years trajectory in that corporation, they know the pain points, they know the right people, they have tested that inside or within the corporation, then they spin off something that they can eventually sell back to the mother company, in which case it might make sense to include that as a, exit strategy. The rest is just pure bullshit. What's your take on this?
So this is one where I think there's no right answer to the question. My view is more in line with yours. So there's 2 points of view. One is, anybody who's thinking about this stuff in the beginning is thinking way too early. You should be focusing on making a great product and getting the product market fit. That should be your sole focus until you get there. So that's one point of view. The other point of view is it's never too early to start talking, you shouldn't spend a ton of time on this, but to start having conversations and developing some relationships with potential buyers, because this is your ultimate future. So there's kind of, those two sides to the story. And my view is in the middle, I would say more towards your point of view, which is, I think until the company's going very well, you should be focused on the product, focused on sales, focused on growing the business, focused on, frankly, creating a great business, the best business that you can create. But once you're kind of thinking, once you have that board meeting or that internal founder meeting where you have the conversation, either you get approached or, companies get approached all the time. So maybe early on, they just kind of ignore it. But I guess it's kind of more when you have that conversation with your founders or board members and it comes up, hey guys, now is probably not the right time to sell, but maybe in, 2 years, something like that would be, could make sense given our current growth trajectory, our current goals and plans for the business, et cetera. And I think at that point, it would definitely start making sense to start thinking about it, thinking about strategy and start preparing yourself for, that eventual goal. So that's kind of my view on the topic.
Let's start the process then. You're a startup and at a certain point there comes a potential buyer and they reached out, like in which case it could be like, sometimes it's on LinkedIn, sometimes it's, an email, sometimes it's like a phone call, sometimes a warm introduction by somebody But in a lot of the cases, the majority of the cases, if you're new to the game, you will have no prior experience to that. You don't even know how to react. Who is the best person to reach out for a counsel and advice in these kind of situations before you even decide to go for like a M&A boutique or something? But
yeah. So what I would do, so if I'm a founder and that happens to me and I really, I guess I have to kind of pretend. So let's pretend I'm trying to imagine I know very little or nothing about this. What I would do is I would probably have the first conversation with this party, but knowing going in, 30-minute phone conversation, nothing too in depth, casual, informal conversation, friendly. That's how I would think about it, and learn what they want, because many times it gets introduced as, it can be introduced in many different ways. Usually they're not saying we want to buy your company for 50 million. It's something like, there could be a strategic fit or collaboration between our companies, what have you. It can be, introduced in infinite number of ways. So I would have that conversation, obviously not revealing anything confidential, just to understand where this other party's coming from. What do they want to do? Are they interested in buying my company? Are they interested in doing something else? I would have that conversation. And then the next thing is, what you want to start doing really quickly is you want to get an NDA in place. And if the other party is a pretty professional party, they'll understand that. And I would say they would even possibly bring that up on the phone conversation. So towards the end of a lot of these calls, it's kind of next steps come up. And so, an obvious next step is both parties need to think about it. Could this make sense? Talk internally. And, I would even bring up, either at that point or shortly after via email, like once you decide it's worth continuing the conversation, you want to have an NDA in place before you continue that conversation. And that's to protect your company for tons of reasons. It's not just confidential information. A good NDA will typically have a non-solicit, for example. So that means, if they really like your company, part of the benefit they get from your company, maybe they could get by poaching 5 of your best employees, maybe your best programmer and a few other people. So getting this NDA in place that says non-solicit, you cannot hire any employee from my company for at least 2 years or, whatever, then that protects you quite a bit as well, because the more they learn about your company, the more they may want to poach these people. So it's not only for confidential information, it's also for just kind of setting the ground rules about, if we're going to talk, we need to have certain things in place. So I would say that's a key aspect. Another conversation could be, with some of your investors, if you have good professional investors, VCs, for example, or it doesn't need to be a VC, but somebody who's had some experience in M&A, have a conversation with them. That's an easy, free conversation. Reaching out to an M&A advisor would be free as well, but that's an easy conversation to have. You already know the person, you know how experienced they are in this area. You can usually line up that call pretty quickly. So that's an obvious one that I would do as well. And maybe, other people in your network that are experienced in this as well. So those are kind of the 3 things, that I would do. Definitely, I would probably have the initial conversation. I wouldn't be demanding an NDA before we've even talked for, a 15-minute informal conversation. But after that, if I decide I want to continue, then I would definitely get the NDA in place. Or even, maybe not, I'm 100% sure I want you to buy my company, but I at least want to learn more. You need to get the NDA in place.
Not a lot of people will know this, but some 3 years ago, we were approached by a potential buyer, and of course, we didn't want to sell. But the thing is, like, we don't have investors, we don't have board, and we didn't have prior experience in other companies, right? So therefore, we didn't have a trusted contact like within reach. I mean, we did have like some friends or whatever, right? But as you said, like reach out to investors or people who know the company very well. Like that was not in our possibilities.
Yeah.
And the most important thing is we didn't know the protocol, right? So is it okay to say to take that call if you're not interested in selling? How do you know? What are you allowed to say? We didn't even sign an NDA for that. So that's something that we, potentially in hindsight, we might have fucked up. Nothing ever happened, right?
Yeah.
But like I remember, one of the things I think we did well. I reached out to one very good friend of mine who sold several companies, right? Sold several companies, and I thought that he could be like a great advisor in the process. We took him for lunch. I mean, it all happened very quickly, and the potential acquirer was one of our clients, actually. So we were a little bit like hesitant about the whole situation. It was like, what happens if we say no? Maybe we'll lose them as a client.
Yeah.
So we wanted to make it as safe as possible. Just make sure that was gonna work, right? So we took him for lunch before the meeting, and he gave us a master class, what to say, how to behave. Don't say this, don't talk about the price, let them talk more, ask some questions, and just kind of like, play it cool. But it was so rushed up that we didn't have time to discuss it within the three founders, right? So this first, let's say that, you take the first call, and then I'm going to go into more detail about how it happened, right? Let's say you take the first call and you decide that it's good protocol to take a meeting, like a face-to-face meeting, right? When does that typically happen? How should you behave in that meeting?
So the first meeting, I would say you would definitely want the NDA in place. So the first conversation, you would maybe as a quick phone call, something like that. Usually the buyer's going to be in a different geography, so it's natural to have a conversation either on the phone or like a Zoom or whatever, Google Meet, for the first conversation. Sometimes
it's taking the meeting like a signal. You're sending a signal that you're interested, or you're just being cordial.
I think you're sending, and that really depends on your language in the emails. Right. But so I would, that's another point, a good point to bring up is, in the emails and in the conversations, I would be clear, and I do this with my clients as well. My client's not interested in this, but, I'm here, as his advisor to, learn about inbound inquiries and kind of understand what your motivations are and these types of things. So that's part of my job with a lot of clients. And so I would make it clear, look, we're not interested in any sale or anything like that, but we're always interested to know when somebody approaches us interested in our company, kind of, if there's some collaboration or something like that we can do together.
Okay, because what we did here is like after we went for lunch with this friend, and then we said, okay, we'll meet the client, the potential buyer, and we had a meeting in which we knew the basic rules of don't talk too much, because basically we're unexperienced, and we could just like whatever you say, you might fuck up.
Yeah. 2 reasons for that. So one, you don't want to say anything confidential. 2, this is an optimal learning opportunity, and the more they're talking, the more you're learning. The more you're talking, the more they're learning. So you want to be on the listening side, because that puts you on the learning side, which is the learner is the winner, more or less. Obviously, you want to be friendly, and you don't want to be too coy and not saying anything, because that's just unfriendly. So you need to kind of have a little bit of balance there. But yeah, ideally, you're learning the most information possible in that meeting.
And it appears to me that in these kind of meetings, whatever you say just drives the company price up and down by the minute, right? Based on your answer, right? And I remember we took that meeting. It was clear for us that it was not a right fit because of terms of culture, basically. Yeah. But we said, okay, we'll just discuss about it. We had a very informal, if you will, first meeting, which we exchange impressions. We ask some questions as to what will happen in this scenario, what will happen with our culture, what will happen with our team, with our clients, things that show that you're worried about what might happen with the future of the company, right? But we didn't commit to anything. We didn't even talk about like price. We didn't ask. They didn't say. Yeah. But I remember there was a funny moment in which we went out of the meeting. And we walked for like, a safe number of meters with my two co-founders. And we're like, I remember asking them, we're not going to sell. But if we sold, what would we be doing in 5 years' time? Because more often than not, you've got this clause in which you have to, like a permanence clause, right? And they both answered something like along the lines of the same company. And then I said, why the should we be selling then? If we, it's taken a lot to kind of like, bring this up and like maintain the company. In that sense, follow up to that meeting. What should be like correct wording, correct follow-up email, some formalities that we should be doing there?
Yeah. So, I mean, the safest thing you can do, I think, if you decide you want to, keep this conversation going, the safest thing is to hire, a professional to kind of help you with this conversation. But if you're doing it yourself, if you want to do it ad hoc, so in the hypothetical situation is you are interested in continuing the conversation. Is that right?
Yeah, I mean, in that case for us, it was, we wanted to continue the conversation, but like not that conversation, the conversation of them being clients, So there was conflict of interest, right? For us, there was this conflict of interest. Yeah,
it's always sensitive, if it's if you're at the table with either a current client or a competitor, for obvious reasons. So in your case, the client is the one who approached you. Yeah. So, I mean, that's a very sensitive situation. I would certainly reaffirm that, you think you guys work great together. You love having them as a client, all the obvious things like that, should, I would say, even though they're obvious, it's just, reinforces positive goodwill and good feelings, try to keep the feelings positive about that. And, depending on the structure of the company, you can say, we're just, in the friendliest way possible, we're really not interested in selling right now. Say, you've spoken internally, and as much as you guys get along with the client, it's just not a good fit. There's not really a great, way, I think, to say that, but just, try to keep the client relationship going and do it that way. How did you guys do it, by the way? Because it's obviously something you had to do.
Yeah, I think that we took a second meeting, if I remember correctly, because we somehow thought about, we've taken a meeting. It doesn't feel polite to send an email. It feels too cold, right? Let's take another meeting and we'll explain it there and we'll give our reasons. And, we thought about it and we think it doesn't really make sense. We're happy to continue with this collaboration, so on and so forth. So that was going to be my next question. So if you take a meeting, you should explain the yes or no in a meeting, or an email is always good, or a call. Is there some sort of formality around how you convey these things?
Well, in your situation, for sure, I think you did it the right way. This is a client, so this is a super sensitive situation. So I would, have that meeting and maybe even bring some sweeteners to the meeting, such as,
some pastries.
Pastries, literally, but also kind of sweeteners in the sense of hey, we love working together. Maybe, new things you can offer them. By the way, this is not the company sale. It's not something, we've decided we want to do. If we were interested in selling it all, you were certainly somebody that we would want to talk to, but we're just not interested. We had a second talk about this, but, we love having you as a client. By the way, with our client relationship, we think that, there's these new things we can offer you, and, not trying to upsell, but just trying to add, show them that you love them as a client and give them some love in that regard. So that's kind of what I'm thinking, and things you can offer them that maybe don't cost you anything, you're not going to charge them money for, ways that you can show them love in the current relationship that you have.
Well, I think we did it the right way because we managed to keep them as a client for 2-3 extra years. So that was good. But excellent. I don't know, when would be the right time? Because in our case, we didn't want to continue this conversation, but a lot of people might want to continue this conversation, right? Especially now that we're facing this market recession, consolidated times. So we're seeing a lot of M&A happening. Yeah. So when is the right time to contact an M&A boutique?
So if you're willing, so it totally depends on your motivation. So if you're interested in selling, or if you want to do a transaction, then it certainly makes sense to talk to the relevant professionals. And, an M&A boutique would be on the early end of the spectrum. An M&A lawyer would need to be involved at some point too, but that's something later on, because they're more involved in the drafting of the documents and the final contract for the company sale. And that's towards the end of the process. So you kind of have even if you're starting the conversations now, you typically have at least, depends how fast you want the process to go and how fast the process is going, but you've got at least 3 or 4 months, if not quite a bit longer, before you need to start having those M&A lawyer conversations. And, as far as hiring an M&A boutique, that's totally depends on your objectives. And also there's founders, as you mentioned, Alex, that, have done multiple company sales themselves. Maybe they feel no need to hire an M&A advisor. I think
that's good to know.
I think that's not, usually they'll still get tremendous value from it. I know a guy, I know more than one person, but I believe one of the senior people at a Barcelona tech firm that sold in the last 2 years, he was an M&A advisor. He worked, I think, at Morgan Stanley or one of the big, I think maybe Deutsche Bank in London for multiple years doing M&A at the highest level. And he still hired a boutique. He didn't hire me. I was disappointed, but he hired a boutique. He hired a boutique to help him, one of my direct competitors. And he had a good outcome. And this is a guy who knows a tremendous amount of M&A, and he certainly doesn't need anyone to tell him how it goes. But it's a ton of work, and it also depends how you want to do it. If you want to do kind of an optimizing process, so there's you can receive inbound inquiries, and you never want to just have one offer in hand. That's just a very suboptimal situation, which I can explain at some point. But so if you want to create an optimal situation, you need to speak to as many of the relevant parties as possible. And then you kind of create a bidding situation. So you create a situation where you try to time the offers. You have conversations with, 20 to, maybe you start conversations with 100, but most of them are not interested. So you end up having conversations with 10 or 15 or 20 different companies at the same time. Maybe you get offers from 5 of them, and you try to time the offers at the same time. So you have your inbound offer here, and then you're speaking to some other people. And more often than not, one of the new people will outbid the original offer. But even if that doesn't happen, it's still very advantageous to do it, because it creates kind of a FOMA effect, the fear of missing out. It makes your company look much more attractive when many other people are gunning for it, potential buyers. So in any case, it depends on, what kind of situation you want to have. I've heard of, and I'm sure you've heard of many situations of founders who sold their company and did it by themselves, and it worked out fine, and it's, sometimes I look at those and I kind of, I kind of feel that it's possibly a little bit sad for them, because also sometimes I know the buyer, and I know that this buyer did not make a really high offer. And I look at their business and I think, this guy, has an awesome business. And this private equity, usually the private equities are not going to be great bidders. So, but this private equity, I know what they bid the last 5 or 10 times I was talking with them. It was never a great offer. These guys don't make very high offers. They're looking for great deals. Private equities are investors. They want to buy low and sell high. So they want to buy your company for a low amount, ideally with no other competition. So no other buyers at the table. They can get a great deal, and then they sell it, 4 or 5 years later for much more money and make an outstanding return. So many times when I hear about these situations, and it's not because they didn't choose me, because there's way too many technology companies in Barcelona and Spain in general that, I can't work with all of them, even if they wanted to work with me. There's just way too many. So it's not about that. It's just, I love seeing when companies get a great strategic fit and they get a great price for their company. And I've seen, having worked in the industry for many years, certain buyers you just know are not, don't make great offers. Some of them are notorious for making horrible offers. Yeah. But then there's a lot in kind of in the middle, kind of in the low, and a lot of these most of them, I'd say, are private equities that don't make great offers. It's not necessarily a horrible offer, but it's kind of just barely acceptable. And it's a shame, because this is a famous Barcelona tech company. It's like, I would have loved to see these guys, maybe they don't disclose, they don't disclose the amount, but I know that maybe they could have gotten double or more from a good strategic fit. So it's a little bit sad. Yeah.
And disclosed amount is usually code for not enough money, right? So one wisdom nugget in what you said is that if you're being approached by a private equity, you should definitely get an M&A boutique, because you need other bidders. Otherwise, you're going to get a very low offer. So if I ever am approached by a private equity, I'll be like, I'm gonna call Mike. So adding up to that, what is the best way? What can we? Because services companies, we don't have the best reputation out there, especially lawyers, consultants, what have you, right? I always like to advise people, even if people we're not going to work with, on how to choose a good development company, a good development agency, right? Because most of it, companies like ours, MarsBased, will live off the bad reputation of the rest of the world.
Yeah.
Right. Pretty sure you guys are the same. So how to tell what's a good M&A boutique and what's a bad M&A boutique? What are the three things that we should be very wary of?
Yeah. So I think, good M&A boutique versus bad. So I want to just take a half step back, because you said something, and there was something else that I wanted to mention related to the talk a second ago. So about that, I think every time you're approached by one buyer, you want more parties at the table. So whether you hire an M&A advisor or whether you do it yourself, you need to know, but it's much better for you if you think about who could get the most value from my company, and start reaching out to those companies in order to get other people at the table. So kind of as soon as you get this interest, if it's something real, a good interested party that's, that you like, that you're considering, hold on. Sorry. So anyways, excuse me. So I think it's echo in the room. So, so I'll speak a little bit softer. So if you're, in any case, you want to have multiple parties at the table. And
it rises the price up, right?
Yeah, it rises the price up. It's also backup options. It's also the buyer who you're originally speaking with. They know that you're speaking with other people. So when you're speaking with one buyer, they have all the leverage. They kind of, especially when you're interested, when you're continuing in the process, you keep talking to them, they know I'm the buyer, and they can drag you along in this process. And I've seen it many times where towards the end of the process, they may lower the price quite a bit. So they've dragged you along for 6 months or so, and then they lower the price. And it's kind of, you're in a bad situation. You wasted a ton of time, a lot of energy, maybe hired people to help you, lawyers or whatnot, and then they lower the price, they make up some BS reason typically. So that's a horrible situation. If you have other parties at the table, first of all, it's way less likely that that's going to happen, because they know if they try to pull something like that, you're going to go to the next party. Right. Secondly, if they actually do that, you can go to the next party. Third, there's a good chance, whether it's a strategic or a private equity, if you bring more parties to the table, there's a very good chance that the other parties, what's the probability that the first party who comes to you gives you the highest offer? When
I don't know.
Later you bring 5 more parties, you get 5 more other parties interested. The probability is just, is that one of the new parties, and this is usually what happens, comes with a higher offer than your original offer, the original party that approached you.
Yeah.
So it's, there's so many reasons why getting other people at the table is just so much more beneficial for the founder. Whether it's a strategic or a private equity, I agree with you. Typically strategics make the higher offers compared to private equities. Some private equities do make good offers as well, but others have reputations, and this would be probably extremely difficult or impossible for a founder to know kind of which ones are more the bottom feeders who give low offers, super low offers, just trying to, buy super cheap and sell it later at a much higher price. So that's kind of how I would, I just wanted to mention that.
Oh yeah, sure. Then, and that's a really good position, because one of the things that we bring into the table as service providers is our accumulated experience, having seen different projects, thinking outside of the box, so on and so forth. But let's go back then, or circle back to the good and bad sides of how to choose one from the other.
Yeah. So I think a lot of it is kind of your comfort. So first of all, you want to meet the people. You want to feel in the meeting that they understand your sector. You certainly want to ask about their track record. So you want to ask about things they've done in the past. I think this is kind of an obvious thing. But beyond that, you want to really feel like they understand your business really well. They understand your sector very well. Ideally, at least one or multiple of the work experiences that they have been in your area. So that's, those are a few things. I think, you want to have the relationship ideally in a little bit in advance of so even if, you're not sure, you want to hire an M&A advisor at all, it's much better to kind of develop a relationship a little bit before you need the person. Because if you get an inbound offer comes to you, then you have to start scrambling. All right, start asking your friends, who are the, decent M&A advisors in Barcelona? And then you start calling all of them. You want to have meetings with all of them. You certainly, you want to, feel that you're making a good choice. So all of this stuff wastes a lot of time. So, it's much more ideal to do this type of stuff in advance. And then if and when you decide you want to hire somebody, at least you kind of know, this company is the one that I want to hire, or this specific person is an advisor I feel comfortable and confident with. So I would say doing it in advance, obviously looking at their track record, having, in the meetings feel, a comfort level with the person in the company, but also feeling that they understand well your sector and your business. I think these are kind of the aspects that I would look at the most. Also, being local is huge.
All right.
Everything now
local to you, not to the buyer.
Yeah, to you, exactly. Because at some point, buyers, are going to be visiting you, and you're going to be having important meetings at your office. And yes, if you hire a boutique in London, they can fly in for some of those meetings, but
it's going to be more expensive.
But it's going to be more expensive. And if somebody's local, you can have them at every single meeting, whether it's the most important meeting of the month or just kind of your regular weekly meeting, to talk with them, to prepare documents. Tons of documents get prepared in these processes. For example, there's kind of the staple documents, the memorandum, the financial model, the teaser. So, those always get prepared, but in the conversations with the buyer, they may ask you, all right, I want to see, retention metrics, all of your clients for the last 5 years, the trend in retention, and, what was the churn each year, the trend of the churn, how many were upsold, how many, maybe you kept as clients, but their spend went down. So you have to do tons of documents. This is just one example that's fairly common. But the M&A advisor is typically the one who prepares that and makes it look really professional, usually in conjunction with your company. So anyways, there's tons of this stuff that get prepared, and being in person makes a much better work dynamic than everything long distance. You don't have to be meeting every day, but being able to sit down and go through things together is a big advantage, I would say.
And these are like the good things you should look out for. I look in this process, right? But sometimes it's not so much about choosing a good one; it's about weeding out the bad ones, right? What would be the red flags? What would things that if I see in an M&A boutique, like I should not go for them?
Yeah, so I mean, minimal track record. Minimal or no track record is kind of the big, most obvious red flag. And yeah, I mean, I would say that's the biggest thing. Not understanding, it's kind of the opposite of what I was saying before. So, you sit down with them, you have a meeting, you're explaining your business, and you just don't feel that they're getting it, and it's okay. And if you have a complicated business, maybe it's going to take a couple meetings for them to get it. But at a certain point, they need to understand extremely well your business and your sector. And, if you think you've given a reasonable amount of time for them to understand it and they're just not getting it, that's a killer as well. So I would say that's something. Also, if you hire somebody from, another city, I would be super confident that they bring, something else to the table. They're just the best, have an incredible reputation, something like that. Because otherwise this long distance, is not beneficial for your company. Again, they're only going to come in for the most important meetings of the whole process. Maybe they fly in 3 or 4 times in your 1-year work relationship, something like that. I've heard of times when they flew in 0 times, so it's kind of and actually never met the founder once in person, everything. And it's, I guess, hard to say how that went, but it's not, it's certainly not ideal. So.
Ideal. What's the one word that we get to hear a lot in this space? And I'm not sure, I'm just asking genuinely, I don't know. What's the difference between a broker and an M&A boutique?
So again, I'm in the M&A boutique category. So we do a process kind of from A to Z. And I think, most of our competitors do as well. So we do everything. So it's kind of, and if we can't do something.
Brokering is just one part of it then?
I think the broker part, and I actually don't know any brokers personally, and I've never competed on a deal that I know of. Maybe I've competed, if you didn't tell me, with a broker. But my understanding of a broker is that it's more just kind of like, they'll, maybe advertise your companies for sale, or maybe just kind of do a mass outreach to some people they know about your company being for sale. And I don't know for a fact, I would imagine that a broker charges lower fees than an M&A boutique. Although again, the broker side, I've heard that, term being thrown around a couple times, but I think that's a more kind of super minimal process. Maybe they just kind of reach out to, 50 or 100 people and trying to bring buyers to the table for your company, bring acquirers to the table, something like that. But I need to qualify everything that I've said about brokers with, I'm not 100% sure, because I don't, I usually almost never compete with them, and they're kind of a little bit different, quite a bit different than what I do.
No worries. I heard it a couple of times and I was pretty curious about what would be the difference. Maybe they were kind of like the pirate guys trying to do it. Maybe just like individuals doing one part of the process. I have no idea. So let's move to the process, because one of the things that, might be really frustrating for founders is that, it's not a short process, because you get your first bid. Then you start working on it. You take meetings, you search for the M&A boutique, you prepare, maybe this goes along really well and you want to take it farther, but then you start getting the inbound petitions from offers from other companies, and then you start negotiating. One gets out of the negotiation table, then another one comes last minute. This might stretch out for how many months usually? Are we talking about this can be months or even years?
Yeah. So again, this is probably a good reason to professionalize the process as well.
Correct.
So I think professionalizing the process, by bringing a lot more buyers to the table, I'm speaking about sell side M&A now, which is the most common for startups, the most common for your audience. The other side of M&A is acquiring companies. Most, tech companies and startups are not looking to buy other companies. We certainly have had situations of that, and we've helped companies with that, but that's not nearly as common as companies looking to be acquired. So for this part of the conversation, I'm going to focus on this, what's called sell side M&A, which is companies that are looking to sell their company or be acquired. So
especially before Series B, you wouldn't be acquiring another company, right? It's like not very likely, because you don't have the capital for it.
Yeah, well, you can. You can do a share swap, for example, which is common. So my company is much more valuable, and so it's, that's somewhat common. But
you don't have the capital usually, because you're still before Series A, you're not even profitable. So why incurring into more debt to acquire another company? You don't have the processes. You don't have, you might not have even the structure. And chances are you're buying like a really smaller company, which is not a huge advantage for you. I don't know. That's my
generally speaking, I agree with what you're saying. The one caveat that I would put in is that, for example, a company we sold in 2019 only had seed investors, but that was, I don't know, I think that was, if I remember correctly, maybe 2013 or 14. So they got to profitability, and they got very profitable. And and so that's kind of, so the, if a company raised their Series A within the last, 12 to 18 months, they're probably not profitable. I agree with that. But there's many companies that raised a Series A and got the profitability, grow, more money coming in, and then they start buying companies down the line. So that's kind of the difference that I would only add in that situation. But yeah, how long can the process last? It depends how smoothly it goes. It depends if you professionalize it. But normally when you professionalize it, if you try to, group so that the offers come in all at the same time, kind of optimizing the process for what we call a competitive process. So you want to maximize the value of your company, accept the highest offer or the best terms, which is, quite usually the highest offer with regard to price, although offers can have a lot of shapes and forms. So that's, it may not be, but anyways, I would say if things go pretty smoothly, maybe 8 months is pretty common. 8 to 10 months, I would say.
Which brings me to the next question. It's one of the reasons why you might want to outsource this is because you don't have usually mental bandwidth to run a company and then sell it at the same time. Because you're conveying two different messages, right? To your employees, you normally you wouldn't tell it, right? Because that's something you need to keep from the public.
Sometimes they don't. Sometimes they tell it at the very end of the process, kind of.
Correct.
A few weeks before, it's kind of in many of those situations too. It's like all the employees kind of figured it out and they were okay with it. That's maybe not ideal, but sometimes it happens and you have to roll with it. But usually it's kept confidential, and more important than that is that you're exactly right. The CEO, and usually there's more people that need to be involved. The CFO is it's much more ideal that person can be involved as well for the financials. So it's a tremendous amount of time for those people. So you should, if you're a CEO planning on spending, and if you're going to do a loan, it's not going to be 8 or 10 months. It's more likely it'll be quite a bit longer. It could be 12 to 24 months, something like that is probably more realistic if you want to do it yourself. So, and any process can be elongated as well, kind of, basically if the first bidder that you accepted ended up not working out for some reason, then you have to kind of take a step back and do a new bidding process. So even well-run processes can go much longer than 8 to 10 months, and poorly run processes often never finish. So it's in the company, it doesn't work out at all. So that's, and those can go on forever. So.
I mean, one of the things here to kind of to touch on is that if you're running an M&A process, you're probably just leaving other things unattended, right? Like sales, team management, whatever. So the company's going to suffer, and that's one of the reasons why a lot of companies, especially if the M&A process doesn't really go well, or doesn't end up successfully, the company has suffered from it. So, some metrics will go down, team satisfaction will go down. There will be more burnout, more stress, just because you're for a year or potentially 2 years focused on something that might not happen.
Yeah.
How to calibrate this balance? How do you keep the expectations aligned here with the founders and every stakeholder, basically?
Yeah, so obviously we carry as much load as we can, and we take a lot of the weight off them. But even in the case where an advisor's involved, the CEO is, it depends how many people the CEO chooses to have involved, but the founding team or the senior leadership, there's going to be a good amount of involvement in any case, because they need to help. If somebody requests from me all this, this custom doc that I just mentioned to you about clients for the last 5 years, the churn rate of each one, upsells, downsells, things like that. I can't just create this document out of thin air. I need to be communicating with somebody at the company. Also, the buyers are always going to want to speak with the CEO and senior leadership of the company, because part of what they're buying is these people, their performance ability and, their ability to keep the company going well, especially during the transition period. So after the acquisition happens, there's kind of, a 1 to multi-year transition period. It's almost always at least a year, but, can be 2 years or a bit more when, the founders, the selling founders stay and, are transitioning in order so that the buying company can put a new CEO in there, new leadership in that company to take over.
What would be the more or less the estimated dedication of the executive team of a startup involved in an M&A process? As in, is this something you need to be fully focused on, therefore full time every week? Does it take a couple hours a day? It's a couple of days a month? I don't know.
Yeah. So, I mean, it's a ton
I have
of work.
no idea.
It also depends, again, if they're going for the optimized process, like they want to maximize the value of their company.
Yeah.
In that case, they want to get as many of the most qualified buyers to the table as possible, because you don't know which one's going to give the highest level. So that obviously is much more time consuming. Or if they're just kind of, hey, we've had it, we're throwing in the towel, somebody approached us, it's a pretty good offer, and we're not going for an optimal process. It's kind of, we've got this at the table now, and, maybe we could get much more from somebody else. So if you're just only communicating and working with one buyer who's, again, probably, and I certainly don't recommend this, but who's probably not, the highest bidder, and that's obviously going to be much less time than if you're trying to have a fully optimized process, having, and getting the highest bid possible for your company, which is going to require, just because you're communicating with so many different people, it requires a lot more time. So it really depends, on the type of process.
I'm a huge believer of you don't get rich by selling companies, you get rich by buying them. And in your article, there was something similar. It says companies are bought, not sold, right? Yeah. So by this token, what are like certain actions we can do when we are in the process of having the talks with potential buyers to increase not only the likelihood of selling the company, but the price of it, right? What can you do in that moment? It's like, now I know that if I do these 2-3 things, I'm going to increase the value of the company.
Yeah. So, one thing that you can do is you can do hybrid processes. So you can kind of go out and for example, in the fintech world, Visa and MasterCard both do a lot of investments, but they also both do a lot of acquisitions. So you can go to them, and if there's a strategic fit between your companies, if you think, you can set up a strategic alliance with one of these companies that's going to be beneficial for both, you can always reach out to them and say, hey, look, we think our companies could have this, could collaborate on these 2 initiatives. We think it would be great. Also, by the way, we noticed, that you guys sometimes make investments. We have tons of investors we can speak with, but if you could be interested, we're happy to have a conversation. And many times an offer will just come from that. So they may say they analyze the businesses, they look at the fit, and they may say, all right, we can offer you a 10 million investment, or they may just say, look, we know that this isn't what you wanted, but we actually see a ton of value here. And so we're willing to, we could be willing to buy your company for, a strong valuation, or, say, basically convey interest that they're interested in potentially buying your company. Usually they won't say the value on the first conversation or the first talk, although you can always ask. But that's one way that you can do it. Another thing is just, similarly reaching out to potentially, their potential buyers, but not saying, hey, we want to sell our company, saying, hey, we see a lot of strategic fit between our companies. Let us know if maybe we can cross-sell our product. We have this wealth management software product, and you have a software product about how people can optimize their savings. So we can combine my wealth management software with your savings software and probably make some, and do something great. So you're not saying I want to be sold, but you're kind of sharing, a ton of really strong arguments about how your 2 companies together could make a lot of sense. And it doesn't have to be an acquisition. It could be just a cross-selling situation or a strategic alliance. But the common thing is, starting these relationships. And at some point, if this other company is a company that believes in making acquisitions as a part of their strategy, then if they see the value there, then there's a good chance that they will make an offer on your company. But you didn't tell them, you didn't say right out of the gates, hey, we're looking to be sold, and go for that approach. So that's kind of the idea, kind of approaching in an indirect way. To put it in, I said a lot of words, I probably spoke too much, but I would, to put it more succinctly, I would say, reaching out to potentially strategic fits in an indirect way, saying, starting the conversation, by the way, our companies, have a lot in common, maybe we can do some type of arrangement together, whatever. and it's kind of vague what I'm saying, but in reality, you don't have to be vague. You would be much specific.
Like a new partnership or new contract might increase the price of the company, right?
Yeah, exactly.
Or maybe they want to initiate talks as well, right?
So then you start with that. You're not saying I want to sell my company, but then if they're a company that makes acquisitions, there's a decent chance they'll make an offer for your company. So that's kind of the way where you can be proactive, but not saying I'm looking to be, bought, or I'm looking to sell my company. So then, they still have to take the initiative and say, I'd like to buy your company, which, gives you a little bit of extra leverage, I would say.
Right. We're running out of time. And the more we speak, the more I realize I know jack shit about this M&A world. And I've got so many questions. So we'll definitely have to record a second part to this. But there's one question I really want to get your opinion on, because it's something I struggle with every time when I'm doing sales, right? I'm doing business development for a company as the CEO, and I'm trying how to find the price, how much are they willing to pay for your company?
Yeah. So, how to find out. So this is where, first of all, I think
nobody knows, right?
It's a tough question. So, what we usually do and what most clients want us to do, and they can do it on their own or hire, an accountancy or some other company to do this, but basically try to do a company valuation. So I would do that first, just so you kind of know, and that's never the price that the company gets sold for. Sometimes it gets sold for much higher, sometimes a bit lower, but at least it gives you an idea of what's my approximate value, so that you're not going into the situation blind. So that's kind of point one, to kind of take away a lot of that ignorance about the value of your company, which is much better, way to begin a process like this. Point two is, if you want to get the highest offer, the number one strategy is creating the most competition possible. So having many offers at the table and timing them so that they're at the same time, and having them know that they're being timed and at the same time. So it's kind of, all right, the date is March 15th. We need LOIs at March 15th, something like that. And
just a letter of intent, right?
Yeah, letter of intent, or any type of written offer that specifies, and you can tell them exactly what you want. So usually when we communicate the date, we also communicate exactly the information that we want in that written document, which is usually referred to as an LOI. So we want, the price, the terms, is all the money up front, or is it, part of the money up front and then there's an earnout, or, there can be tons of different structural aspects. We want to know, has this been board approved? Is board approval necessary? If it's necessary, has it been approved? If it's not approved, what do you need to do to get it approved? Is that in process? So there's a lot of different aspects like this that, we put in like a letter that we send out, so they know not only what's the date, the final date that they need to make the offer by, but also what should be in this offer, specifically. And it's not too much information. It's, a page or 2 pages, typically the letter or the offer that they send us. Sometimes they make it longer because they have a standardized document. Companies that do lots of acquisition have a standardized document that may be 6 or 7 pages, but usually that's not necessary.
Okay,
so anyways,
sorry.
Yeah. No. I forgot what the question was, but hopefully that answered it to some degree.
The question was how to find the price.
Yeah. So anyways, finding the price, the ideal way is to, create what a lot of finance
create more demand,
an efficient market, and create more demand and see who the highest bidder is. An auction environment is the best way to find the highest bidder. So, a situation when people know they're in competition, that makes your company seem very exciting. They know there's many other buyers. Oh my gosh, I'm not the only one who thinks this is a really valuable, attractive company. Many other people do too. All right. And there's ways you can kind of let them know that there's many other people at the table. And so this really moves up the offers quite a bit. So I would say that's the number one thing that companies can do.
And last question, and this is our signature question, and this is the most uncomfortable question ever, because basically one of the things that I think we do the right way in our companies, we're very human at accepting failure and fuck ups, right?
Yeah.
And we share them. We're the first people to say, like, we're super experts on these technologies, but we also fuck up because everybody fucks up. So here's my question to you: is what's your biggest fuck up in an M&A process? One that you have made? because it's very easy to tell somebody else's fuck up. A lot of people come here, so like, oh yeah, I heard once my colleagues like, no, you.
Can we save this? Can we save this for part 2?
I'm gonna think. I mean, obviously, if it's gonna give you like legal trouble, I mean, just don't do it. But like, if there's something you can share, which like it's client agnostic, you don't need to say the name, but like story that we can learn from, right? We can humanize.
Yeah, no, there's been processes that didn't work out perfectly for sure, and so I'm trying to think of one where my particular role was something I did was bad. Or may have caused some issues, and I would never claim. Obviously, I'm not perfect. Nobody is, but I'm thinking hard about. Bear with me for 1 minute.
Yeah, no worries. I'm going to share one that I just realized today. We've been working for this client for 2 years. We don't have a contract in place, and that's the second time it happens. So, and it's my fault. Like sometimes I just forget to sign to send the contracts. Like if the other end doesn't really claim them, it's like, oh my God, we've been working for 3 years without a contract.
Yeah.
Fun. Like, it's a fuck
Actually,
out.
now that you mention that, it's when you ask a really open-ended question, sometimes it's hard because it's just this whole world of opportunities. Like I can't think of anything specific, but one time I did a poor contract with a client, and at the end it was slightly ambiguous what our fee should be. So basically it was kind of, obviously we thought the fee was the higher number and they thought the fee was the lower number. So this is one of our early clients. This was, say 7-8 years ago. But anyways, it was an awkward situation, and, fortunately it got worked out in a friendly way. Nothing bad, but it was, it's contracts are super important. So that was.
How much money was the difference, more or less? Can you quantify it?
Yeah.
I mean, normally I ask the questions like, hey, what's your fuck up, and how much money did it cost you? So that's the second part of the question. But like, was it very big, the difference, or
it was hundreds of thousands? Yeah.
Yeah, that's a pretty big number.
Yeah.
And it didn't work in your favor. It's not like my first fuck up in the company.
We reached a middle ground. So it wasn't. So and to be fair, the contract wasn't perfect in that situation, so I'll take some ownership for that, and so it's not like I was perfect, it was a screw up, but it was okay. We didn't get screwed. The client didn't get screwed. We kind of reached a friendly middle ground, and we still got a nice payday. It's not that we got zero money. We got we still got paid, just not the the super highest level that we were hoping for. So.
Thank you for sharing, because I think like more people should be doing this, and then fuck ups wouldn't be such a big deal, right? Most of the times, like people, we can talk about it. There's just going to be middle ground. We can solve it. We're all imperfect, right? So I think that humanizes you, makes you a more trustworthy person, just because you can share it. You're not like overly selling like we're the best in this. Like nobody's perfect, right? In business, I like honesty. I value people being upfront and transparent. So I think that that's why I hold you in high esteem, and that's why I think that's why you're here. So, anyways, 1 minute for you. What's going on in your life? What can we help you with? Or what should our audience know about your company?
Yeah, so I mean, what's going on in my life? We're an M&A boutique, and we help companies that want to sell, want to make acquisitions. We help with some capital raises as well. Although I would say we've been more M&A focused recently. So if you're, for whatever reason, if you look, if your company's going great, but you kind of feel that now could be a good time to exit for whatever reason, happy to have a conversation, and no obligations. I have talks. And we have talks with a lot, many entrepreneurs, and most of them we don't work with, especially not right away. But I enjoy those talks. I try to add as much value as I can, just like, on this podcast right now. It's all about, helping people and trying to add value. And I think if you do that, then people will eventually come and work with you. So we're happy to have talks with any startup that has any questions about any of these issues. And, feel free to reach out. Maybe I can put my email or something somewhere posted with the podcast.
Sure.
But yeah, feel free to reach out. That's all I would say.
Thank you very much, Mike. Can't wait to get together for beers once this is over.
Absolutely. It's a long time in waiting, Alex. Absolutely.